Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video, we're going to be looking at my M1 finance portfolio that I have. And in that portfolio, I invest mostly in more growth-focused companies. Most of these companies don't pay dividends. Some of them do, but I don't really invest in them for the dividends. A lot of these companies have been rebounding some the past few weeks with the NASDAQ, so it's pretty exciting to see the portfolio value go up again. So just want to share that with you guys and hope you do enjoy. So this right here is my portfolio with M1 Finance. You can see right now it's only $939. So I started this portfolio at the beginning of 2021. I contribute, 10 or $15 a week. Now it's 15, and hopefully I can bump that up a little bit in the future. But we can see over time, just steadily going up and up and up, which is awesome. And the last month or so, the portfolio has really gone up here, which is cool. And we can see over the past quarter, it's done pretty well since May 13th. We were at $577, and since then we've deposited about $181, and the market has gained us about $181 as well. So that's awesome. If we look at some of my holdings, the first one here is VGT, which is Vanguard's Information Technology ETF. And right now that's around 15.5% of the portfolio and done pretty well so far, just steadily adding to this over time. The next one here is ARK, which is ARK's Innovation ETF. Definitely not the biggest fan of ARK. Let's actually go to the full all time so we can see kind of a better performance. ARK's Innovation ETF, this is about 10% of the portfolio. I generally want to bring this percentage down over time, but letting it recover some. I think it will continue recovering some more. If we look at this a little bit more in detail, currently the price is like $52, and my average cost is around $77, which is pretty incredible, I think, because if we look at ARK, within the past year, they started the year around $100, and in the past year they've been up around 120. So I think it's great that our average cost now is in the $70 range, $77. So if we can bring that down a little bit more to around $60, even closer to $50, that'd be awesome. And then as I scale back that position, I think it could eventually do sort of well for us. And if it doesn't, well, I'll scale it back and it won't be as big of a drag on the portfolio. PayPal, this is another company that I like a lot. Right now they are around $100 per share here, and my average cost is around 145, so still down substantially, but again, we're just continuing to average down over time, and the position size just keeps going up as I continually add to it as well, which is awesome. And similar thing here with Shopify, they're down big, around 9% of the portfolio, but again, we're just continually adding and averaging down over time. Again, Amazon is doing pretty decently, actually. They're up, the stock price is up like close to 40% since the split, which is pretty cool. So my average cost is around $150, which is definitely not that great at all, but almost breaking even on this one, which is good. I'm sure they will continue to grow. The next one here is Google or Alphabet, so actually positive on this position, which is awesome. And the next one here is Jumia, which I only allocated 5% of my portfolio to this, but right now they're actually 7.5%. So they actually announced earnings this past week for I think the second quarter and maybe the third quarter. Yeah, the second quarter. I thought maybe their quarters were a little bit weird, but anyway, they announced earnings this past week, and their revenues were up pretty big, and their number of customers and stuff like that were up pretty big, and it seems like it might be a little bit of a turning point for the company. They're definitely still unprofitable, and they have a long way to go to profitability, I think, and their losses actually grew this quarter, but it could be a little bit of a turning point. Obviously the stock has been pretty volatile over the past few years. My average price right now is $11.50, so fairly close to breaking even, but not quite there. If we look back just 2 years, the stock was up 50, 60 bucks at the beginning of 2021, which is I think right when I started this portfolio. I'm not sure, I might not have had Jumia in my portfolio at the very beginning, so maybe I started buying in the $40 or $30 range. I'm not really sure, but point is they're down really big over the past 2 years per se, but I think they could have an opportunity to kind of turn around and continue growing. There was a comment, I think, in the earnings call that, Amazon is starting to expand into Africa, and if Jumia is worried about that, and basically the CEO just said, well, this validates the fact that e-commerce is going to be big in Africa, and Amazon, yeah, sure, may take some of our market share, but we can still capitalize on a lot of it and do very well. Tesla has done pretty well the past month or two. So currently my average cost is around 715 and the current share price is 900. So doing pretty well on that one, surprisingly, to be honest. And then next up here we have Square. Next few are kind of still down big. Square, similar to PayPal, they're around 90 bucks. My average cost is around 132. So not too terrible there. Continuing to average down, of course, every few weeks as I buy, and you can see the position just continues to grow over time. So that's really what is important to me, is increasing the amount of ownership I have in these companies. Similar thing with Spotify and Adobe, and then MasterCard and Visa are just about breaking even. Looks like MasterCard has actually performed a little bit better for me. So my average cost is right around 352, and right now they're around $354 per share. And MasterCard and Visa do pay dividends. So I've earned about 21 cents in dividends from MasterCard. And then Visa here is down just a little bit for me, and I've earned 30 cents in dividends from Visa. My average cost is 218, current price is 211. So continuing to average down in that one a little bit. But overall, I'm really happy with where this portfolio is going. Some of these companies are still down pretty big, but some of them are recovering some with the overall market, and the past 6 months or so has given me an opportunity to average down on these positions, and I will continue doing that until they continue recovering, and even after that I will just continue investing weekly in this portfolio just to see where it takes me. I've been reading this book called 100 Baggers recently, and kind of what I was thinking about with Jumia recently is related to that book, I guess, because the stock is down 80% or something since the peak, and the book is talking about how a lot of companies that have performed very well have had huge drops in their stock price that investors have had to stomach if they want to really see those monstrous gains from those companies. So I'm not really trying to say that Jumia is going to be a 100-bagger, but I think it's definitely the smallest company in this portfolio, and I think it has the potential to grow the most at this point in time. So I'm definitely excited for that company and for all the companies in the portfolio, and I'm excited to hear your guys' feedback in the comments down below. If you have any suggestions or thoughts on the companies in my portfolio, or if you want to share some growth stocks you've been investing in that you think are at a good price right now, I would love to take a look at those as well. So just want to thank everyone for sticking around to the end of the video, and I will see you all in the next one.